one of the things about meditation is to have what's called an observing mind. Most people are in the moment. So if they get upset, they're experiencing the upset.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we have a very special guest for you, Michael Sonnenfeldt. Michael is the founder and chairman of the ultra wealthy investment club Tiger 21 with over $140 billion in assets under management. Michael is the author of Think Bigger and 39 other winning strategies from successful entrepreneurs. He is an American entrepreneur, philanthropist, and political activist. Currently, he is the president and founder of Tiger 21, the premier peer membership organization for high net worth creators and preservers. He is also a board member of Earth Justice and is the president of the Goldman Sonnenfeld Foundation and on the boards of several other philanthropic and political organizations. Michael, welcome to the show.
Thanks so much. Thanks for having me.
Yeah, you bet. Really grateful to have you on the show, Michael. I think this is going to be super valuable to the audience, especially in the time period that we're in. Right. There's so much going on in the world, geopolitically, politically, right. The investment climate seems like we're really just, there's so much uncertainty out there right now. So, and you've had an amazing journey and background as an entrepreneur, as an investor. And so really looking forward to, unpacking some of the wisdom and insights, from your journey. So why don't we start there, Michael? If you can share with the audience who isn't familiar with you, a bit about your background, a bit about your story, and how you kind of got into eventually getting into Tiger One. Starting right back from your real estate days and MIT and such.
Sure. So I'm what would be called a classic serial entrepreneur. I've had 4 or 5 or 6 different business lives, some overlapping, some sequential, and maybe a little more unique as I've split my time between business and my philanthropic activities. They're all related right now. As an example, for the last 15 years, climate has been my primary concern, and I mix it both politically, philanthropically, and in terms of the investments I make. But my career, really, the thing that made my career was that when I was 17, I was working in a warehouse that was on the waterfront of New Jersey, directly across from the World Trade Center in Lower Manhattan. And I was a meditator at the time. And I used to go out to the end of the pier, which was a warehouse then. And it was 1,000 feet out in the water. Imagine the Empire State Building laying on its side. That's how far out in the water the pier went. And when I looked to Lower Manhattan, it felt like it was actually closer than the land behind me. And behind me was a warehouse that had been the largest warehouse in the world, largest building in the world when it was built in 1929. But the times had changed, and I had a vision for that to become a mixed-use office, condominium, hotel, retail center, and what was then the Harborside Terminal. 7 years later, I acquired with a partner and began the redevelopment, which became the largest redevelopment in the country at the time, and converted it into the Harborside Financial Center, which was a great first project. It was fun that my first real estate project was the largest commercial renovation in the world. And it's kind of good to make a career when you have a success that way. And I sold it just after I was 30 and went into the real estate business, went into trying to figure out what to do next. and went into the real estate information business, which was really technology. That didn't work out so well, but a few years later, I went back into real estate and created a $1 billion merchant bank for real estate called EMMES, EMMES. It means truth in Hebrew, and my initials are MS. And then when I sold that when I was 43, I had my second successful exit, and I started Tiger 21, which was about 23 years ago. And now Tiger has grown into the premier network of high net worth investors around the globe with, as you mentioned, just about 1,300 members who manage their own money. We're not a money manager, but the collective personal wealth of our members is now about $150 billion.
Yeah, that's really amazing. I actually had the opportunity to live in Harborside right when I transitioned out of the Marine Corps, and it was my first job working for an international supply chain company.
Wow.
So very familiar with Harborside and all of the freight and all of the activities. And just as you say, and I was there, I guess, early 90s. But still, there was still a lot of development to happen. And, you look at it today and it's just, it's an unbelievable, piece of land and what it has, grown into. But tell us, some of the, decisions that went into that. I mean, at your age, at your experience level, all of us as entrepreneurs, we want to make big moves on the chessboard, but you had to have made some very big thoughts and kind of manage your risk to get into this. So can you tell us a little bit more about the transaction?
Sure. Yeah, as I mentioned, I had this sort of vision, for lack of a better term, just call it an idea, when I was 17. But the building had been owned by my wife's family, which is a large real estate business, but they ran it as a industrial warehouse, and it wasn't very successful as an industrial warehouse. But when I graduated college, I went off with an MBA from MIT. I went off to Goldman Sachs for a year and then went to work for my father-in-law for 3 years. And one of the things I was running was that building as a warehouse. And I had this real burning passion. So I developed some plans about what it would look like and how you would go about it. And I found some mentors, very important. One was an architect who had unusual financial skills named Rick Bear. And he taught me how to think about world-class development or redevelopment. But one day a man walked into my office named David Fromer, who was twice my age. And I showed him all the plans that I had been working on. And he said, oh, let's do it. I had been introduced to him by a common acquaintance, but this was the first time somebody saw the plans and really bought into them. And so it took about a year and a half for David and I to find the right formula that would allow us to acquire the building. In those days, you could have purchase money mortgages, and we were able to get financing. David was able to get financing. The deal that we had between us is because it was my idea and I had the plans. That's what I brought to the table, and he had to bring the financing to the table. And so we became 50-50 partners, where the project was completely leveraged. We acquired a building for $25 million with literally $200,000 down, and the rest multiple layers of debt. And the sellers were happy to take back the debt because they were getting a much higher price. So, one lesson is that sometimes a win-win is when one person gets what they need and the other person gets what they need. In our case, we needed financing, and in the seller's case, they wanted a high price, and we were willing to pay a higher price with the advantageous financing. So we closed in 1982, August of 1982. And in one of the great strokes of luck, and maybe this is the second thing, luck tends to favor those who are ready, willing, and prepared to take the risk. So we closed in August of 82 on an industrial building that was losing money with a vision that it could be converted into modern computer centers. And 6 months to the day later, in one of the great gifts of life, Bankers Trust, which was then the 8th largest bank in the world, leased a section of the building to put half of their worldwide data center. And the minute they did that, the rest of the building became unfinished office space rather than industrial space. And as they say, sort of the rest is history.
Wow, that's really definitely an amazing story. In terms of from a wealth perspective, Michael, I mean, even before you got into really setting up Tiger 21 and creating that community, we know that as an entrepreneur, right, it's a different skill set to build capital than being an investor, right, and preserving and growing your wealth. Have you created a particular wealth strategy for yourself, or some type of guiding thoughts or parameters that you have as you've been building your wealth over the years?
What comes to mind is in order to do what you've just asked, you need knowledge and perspective and discipline, because 90% or more of entrepreneurs who are successful entrepreneurs but then have a liquidity event, and all of a sudden they no longer are running a business, but now they have a pool of capital. They go from being managers and entrepreneurs to wealth preservers or investors. And for people who don't have capital or haven't built businesses, maybe being a wealth creator and a wealth preserver seem like the same thing, but they're radically different. All of the things that allow some of the most successful entrepreneurs to be successful predispose them to be mediocre investors. An example, most entrepreneurs are very emotional about the one thing that they're working on, that they're so excited on. And so to those entrepreneurs, being an investor is kind of watching the paint dry, because investing is much more dispassionate. As an entrepreneur, you focus on one opportunity. As an investor, you have to prudently diversify. And I'm saying all of these things because today, the single most important issue for somebody with a wealth strategy is, one, asset allocation and what it suggests about your view of the world. How you there's lots of studies to prove that if you can pick reasonably successful investments in each asset allocation, the asset allocation is more important than the investments themselves. In other words, if you have a certain percentage in stocks and a certain percentage in private equity and a certain percentage in real estate, getting the allocation of those big buckets correct over the long term is more important than the individual investments. Of course, as long as the individual investments are at least in the median of each of those areas. And in my case now, the strategy that I find most compelling is to think of my assets in 3 buckets. One is cash, and the cash is for both a rainy day, meaning if the market's downturn, can I survive on the cash I have without having to liquidate investments at exactly the wrong time? And in the case of Tiger 21's members, that number is about 12%. Tiger members as a whole have about 12%, 11 or 12 in cash. And if you spend 2% a year of your wealth, if you have sufficient wealth, that's the number. That's about 5 years of reserves that you wouldn't have to liquidate other investments in a major downturn. The second thing is what I would call my passive investments. Those might be index funds, stocks, investment in private equity funds, real estate. We're not operating it, we're just investing. And then the third part, and this is the biggest choice that an investor has to make, is active businesses. Do you have enough of an edge to own or participate directly in businesses that will provide superior returns, but also provide significant risk if you don't know what you're doing. So many people don't have that option because they don't have either that skill or that interest. And so then they have to say, what's realistic if I have stocks and bonds and cash or some variation of that? But the point that I'm making is that unless you have some demonstrable, quantifiable edge in investing in companies, you're not likely to outperform the markets. And historically, that would be sort of an 8 to 10% return in the stock markets, which will be reduced by whatever cash you have. I'll just end by saying, there's a study that shows the stock market since 1910, I believe, has had an average of a 9.6% compounded return. But individuals have only earned in the 4 to 6% range because individuals who aren't disciplined sell at the wrong time. They tend to sell at the low, and they buy at the wrong time. They tend to buy at the high. And that's why long-term ownership of index funds provides benefits that stock picking and even many managers can't match.
Yeah, that was a really great summary. And then from your perspective, why is it that you think, certain asset classes, like let's talk about real estate and private equity specifically, most people don't really have that in their portfolio. Even entrepreneurs who've been successful and then they've had their exit and then they get exposed to those asset classes, which, as you start to understand them and analyze them a little bit more, provide multiple benefits at the same time, especially if you've had an exit, right? You're able to offset with taxes, getting into real estate, investing in energy, some of these other asset classes that can have, multiple benefits at the same time. But most people are still looking at things from the viewpoint of, hey, I can only invest into, the stock market and in a mixed type of portfolio.
Sure. So I'd say that's the largest distinction between both Tiger members, but family offices and some of the wealthier families, that if all your available investment is in the stock market, the bond market, as an example, it turns out you can actually do quite well if you're smart about it, meaning if you had invested just in index funds that mirrored the performance of the stock market, you'd be one of the great investors. As I mentioned, you could be earning in the sort of 10-ish, 9 to 10% compounded range for a long period of time. And what I would say the vast majority of Tiger members and people who inherit money or they come into money for one reason or another have the hardest time understanding is how hard it is to outperform that simple index fund that is earning, over a long time, 9 to 10%. But if you have access to and the knowledge about and are willing to take the risks of the two categories you've talked about, real estate and private equity, if you can perform in the top half and maybe the top quartile of investments, that will bring up your yield, but it's not without significant risk. There was a very famous investor named Swenson who was the head of the Yale endowment that really revolutionized endowment investing. And he came up with what was called the endowment model, and it turned the world upside down. It used to be 70% equity and 30% debt. And he started diversifying Yale's investments into natural resources, forests and minerals and other forms of natural resources and private equity and real estate. And we could go into any level of detail, but the bottom line is that he pretty regularly generated in the mid-teen kind of returns, as opposed to the high single digits, and the cumulative impact of that is to make 5 and 10 times as much money over a period of time because of the power of compounding.
Yeah. And what do you think in terms of a percentage that you see with your members in Tiger from a, let's say more of a defensive, if you have those three different buckets, right? How much are they allocating towards, defensive type plays versus looking at equity appreciation?
So the current asset allocation for Tiger members is about 25%, 25 in real estate, about 31% in private equity. Those two add up, obviously, to 55%. And public equities are only 22%. Well, when you add those up, that's 76%. And the rest is largely defensive. It's cash at 11 or 12% and fixed income in the 7% range. Some currencies, commodities, Bitcoin might be in there, and hedge funds. But the overwhelming point is that Tiger members are relatively unique in the very high allocation to private equity and real estate. Private equity and real estate. Those are two illiquid markets where, if you can find the best opportunities, whether it's through funds or directly, you can, pretty regularly achieve returns that are higher than the stock market, or at the very least diversified from the stock market. But I think one way to think about it is it's a bit of a barbell, very long invested in long-term assets between what we call the three equity buckets: private equity, public equity, real estate can be seen as equity. And then a lot of safety with 12% cash and another 6 or 7% in fixed income. And the cash really is there for the rainy day, and the three equities are there to build value over time.
And would that strategy hold up during different, economic periods, right? Especially, where we are today, would that hold up for you as where we're going to be in the next 5 years, say?
Well, what I would say is, first of all, nobody knows where we're going to be. That's for sure. And, the most difficult form of investment trading is macroeconomic, trying to take the biggest macroeconomic trends and translate them into specific investments. If you want to read from the dean of macroeconomics, Ray Dalio is the man, and he's just come out with a book in the last year on the great powers and the changing world order. And if you read that, you'll see how China is accelerating and the United States is growing less strong. So China is catching up faster, and in certain areas actually beating us on the statistics. And the point about that is, interest rates kind of have a mind of their own, but over the last 20 years, interest rates came down, and over the last year or two, they've been going up. So if you were a betting person, you wouldn't want to bet that interest rates are coming down, or you wouldn't want to bet your entire portfolio that interest rates are coming down. And if you think they're more likely to go up because of the inflation story, you'd have less fixed debt, and you'd look in your equity areas for things that are inflation proof. So a simple example is if you're in a real estate business, if you want inflation protection, many retail real estate leases have a pass-through of sales to the landlord. And so as the tenant, whatever they're selling, raises their prices because of inflation, you get more and more rent as the landlord. Well, that's as opposed to many other types of leases that just have a fixed rate and don't have that pass through. So if you were concerned about inflation protection, you would lean a little more towards having that kind of pass-through rent where you participate in the growth of your tenants' receipts, but it's not always available. And on the private equity side, within private equity, we don't track it, although anecdotally we think why private equity has grown so much over the last 15 years is because of the venture capital component. And when a company starts out, it normally doesn't have debt. You can only qualify for bank debt when the company is up and running and maybe successful and has a track record, and that sometimes takes a couple years. Well, what that means is when the company is in its early stages or its venture capital period, debt is not that important because you don't use debt to grow little baby companies. You use debt to grow much larger companies. So if interest rates are rising, you're going to be less exposed to that as a venture capitalist than as a leverage buyout guy. That leverage buyout guy uses debt for everything. So in each of the categories, there are areas that are more dependent on debt and less dependent on debt. And obviously in a rising interest rate market, if you could fix interest rates at a low rate, you'll get a benefit for many years. But if your interest rate is floating, then you're going to be exposed to the rising interest rates if that's your concern.
Makes sense. Any other guidance you can give on the current economic outlook from a strategic perspective?
These are the strangest times. There are many metrics that are as good as they've gotten. Under the current administration, inflation has come down dramatically. Employment has continued to surge. The stock market is strong. And yet we have this sense of unease. And it probably has to do, at the very least, with three or more factors, each of which is a study in itself. I think the competition that we're now facing with China has truly profound ramifications because just look in the chip area for advanced chips. On the one hand, we still have a lead on advanced chips that go into all sorts of machinery and so forth. But China has an advantage in the rare earths that are the minerals that go into making chips. So they can squeeze our ability to manufacture, and we can squeeze their ability to use these advanced chips. So in many different, as an example, most of us think of Tesla probably when we talk about electric vehicles, and Tesla is accelerating at a mind-boggling rate, doing amazingly well, beating all the records. But most Americans have never heard of BYD, which is a bigger electric vehicle company than Tesla. And the growth in electric vehicles will be at the smaller end through Southeast Asia, and there BYD has a huge advantage. So just generally, China, America, the dynamic is changing. China has caught up in many respects and is catching up faster. You then have the polarization in America politically, which really can take a toll on how people's well-being feels. We're polarized more than we've ever been in certainly recent history. And, climate change, all of a sudden we're starting to see the devastating effects of climate change. And many people really haven't thought through, this isn't the new normal. This is just on the way to things getting a lot worse. And that's going to have a huge economic impact. So there are a lot of different factors that go into thinking about these issues. But obviously, interest rates is the one that many of these gets translated to. And I think one of the things that we really want to do is not be prognosticators, but meaning don't bet the portfolio because you think you know whether the stock market is going up or down. Create a all-weather portfolio that can survive in the downturn and maybe even prosper and better prosper as the world gets better.
Yeah, really sage advice, Michael, and would wholeheartedly concur with that. Because I think once you have a strategy and you're following these parameters, right, of those buckets as you outlined that you're investing in, you have the ability to manage different economic conditions and things that frankly no one can predict. Whatever it is that's kind of coming across the bow for us. Also, I think it's fascinating as well that meditation is really important for you, as it has been for me. I mean, I would define it as actually one of the top 3 skill sets to have in life, and started out trying to teach our kids even, that, how important that was. And you find that with, very successful, business leaders, entrepreneurs, investors, people who have really evolved, have only gotten better at skills such as meditation, regardless of the different techniques and everything. But it's really mastering your mind, being thoughtful, being intentional about making decisions. And really, when you tie that to investing as well, right, and Ray Dalio does like to talk about that a lot, is that, we lose a lot based on the emotions, right? We're making decisions based on our emotions, and that's when we're losing in investing. So can you share with us, your thoughts on meditation and how that's kind of helped you as an entrepreneur, as an investor, to be more intentional, maybe make better investment decisions?
There's lots of ways to both tame and I don't know if I would use the word master your mind, but at least kind of wrap your head around it, for lack of a better way of saying it. And one of it is through analysis. Some people think of psychoanalysis as a negative if psychoanalysis is a way to open up into your unconscious and reveal issues that are on your mind. And meditation is another way. How many times have you heard people say, I was in the shower and I had an idea come into my head, or I woke up in the middle of the night with an idea and I wrote it down. It was so important. These are all variations on a theme, meditation, of course, being one of the most important of them. And for me, I don't, I do get some mastery, as you mentioned, from meditation, but the more profound impact for me is that the more you can clear your mind, the more things can surface that are being held below the surface. Think of it as a meditation is kind of removing a blanket from something and revealing things. I very often, when I'm meditating, something will come into my head that I have absolutely no idea where it came from, but I remember I forgot to respond to an email, or I've been working on a problem that I can't quite figure out the right solution to, and the solution pops into my head. Really what it means is that our brains are really working on multiple levels, and we're not in touch consciously with all of the levels that our brains are working. And our brains are working on some problems that we're not even aware of. And sometimes you can't put all the pieces together, but both meditation and being in the shower, and for some people it's hiking and so forth, finding ways to calm and clear the mind allows some of those problem solving to come to the fore with extraordinary solutions. And sometimes I find I've been working on something for weeks or months, and I can't get there. But with a meditation, literally a solution pops into my head, and it feels like it's the right solution. So there's lots of reasons to do meditating. There's lots of health reasons. And I guess the other one is that when you're an entrepreneur, your ideas are important, but your execution is more important. And execution almost always involves working with other people. And one of the things about meditation is to have what's called an observing mind. Most people are in the moment. So if they get upset, they're experiencing the upset. Or if they get angry, or they're obnoxious, or they're arrogant. But with meditation, you start to learn how to observe what's going on. So you're both in the moment and you're observing the moment. And in every personal interaction that an entrepreneur has with an employer, an employee, or a customer, the more they can be aware of how they're acting and how they're being perceived, the more they can adjust to a more productive mode. And I think meditation is one way to build this observing mind. So you're not just in the moment, but your mind is observing you being in the moment. And, you know, we're all human. If I come into a room and I'm feeling insecure because, as an example, everybody is more successful than me, if I can be aware that I'm feeling insecure, it will moderate my behavior in a way that I don't behave in a counterproductive way. Whereas without that monitoring, I might not behave as well as I'd like.
Yeah. Yeah, no, totally agree with that. It's such a powerful technique. And as you say, I mean, it can really benefit so many areas of your life, you know, in business, with your relationships, with your health, and with investing as well. So appreciate that. Michael, why don't you tell us a little bit about Tiger 21? I think some folks might not necessarily be aware. We have several of our partners, some of our folks in our community and friends of our community, our members. But for folks who aren't familiar, tell us, you know, how it started for you. What is the makeup today?
So I mentioned that I'd built and then sold this very large project when I was 30, a little past 30. I may have been 31. And, you know, I was successful beyond anything I would have ever imagined. But when I sold the project, and now I had the millions of dollars that I made, I had no real thoughts about preserving the capital. In fact, I thought that if I had been so successful the first time, the second time would be just as easy. And so I didn't have well thought out strategy about protecting capital. And I started some new businesses, and I just wasn't thinking straight in hindsight. I overestimated my success, which is very typical when, you know, people who win the lottery think they're geniuses and forget that they won the lottery. On the other hand, they took the risk and bought the ticket, so they deserve some credit, but it's not the whole story. And so I had some setbacks in the next round of investments and realized I needed to be smarter about it. So I went back to the real estate business where I knew something and built a $1 billion merchant bank called MS and Company, EMMES. My initials are MS, and it means truth in Hebrew. And then I sold that business when I was 43. So I'd had two really terrific successes. And I realized the second time I sold the business, I didn't want to ever have to go back to start a third business because I had made stupid mistakes. And I wanted to avoid the mistakes that rookies make. And I wanted to learn from other people who had been very successful and then learned how to preserve the capital and maybe even enhance it without unnecessarily risking it. So I wanted to create an organization around 6 other people who were in similar situation to me. We were all in a Vistage group. That's an organization like YPO, 2 great organizations that their members are mostly CEOs of businesses, and their peer-to-peer learning is about being great CEOs. But once you sell, kind of it's like the Harvard and Stanford undergraduate or the Oxford and Cambridge, and then Tiger 21 today is the graduate school after you sell a peer-to-peer learning model. So I started Tiger really wanting to learn from other people how they were preserving wealth and thinking about legacy and estate planning, and most importantly, children. after they had been incredibly successful as entrepreneurs. And that was an idea 23 years ago. And today that's grown into the premier network of high net worth entrepreneurs around the globe. We operate in a half a dozen countries, growing a few more out. When you join Tiger, you join a group. So we have over 100 groups around the globe. 95 of those groups or more are geographically located. So you might be in New York 1 or London 3 or Tel Aviv 1 or Vancouver 2, because in many cities we have 2, 3, 4, 5 groups. But now we also have global groups where you could live anywhere in the world and join a group, and then you meet by Zoom every month, 11 months a year, except 3 of those meetings you actually meet in person. Depending on where most of the members in the global group is, you might meet in New York and then London, but it's a global group. But regardless, each of these groups have about 12 to 15 members. That's the size. And the reason is that when you meet once a month, one person each month does something called a portfolio defense, where they work very often for weeks, if not months, with their accountants and advisors to put together a way to explain their portfolio decisions to get the input of 12 peers that they just can't get from anywhere else. It's sort of the defining experience. It's all subject to confidentiality. And so today, at the core is a little over 100 groups, about 1,300 members managing about $150 billion. We're not money manager. We're just the organization that puts all these people together in these groups. We curate the activities, and then they meet. And it's a full day meeting focusing on, as I mentioned, the portfolio. We obviously have speakers, but it's sort of like a personal board of directors. You get 12 people who you meet with every month for years. I was in a group yesterday I've been meeting with for 20 years. It's just an extraordinary way to get information about how other really smart people are investing, how they're thinking about their legacy, how they're thinking about tax planning, how they're thinking about their children. But you're learning from peers. That's the model. It's not a consultation. The groups are run by chairs. Those are our facilitators, but their job is to make the magic happen between extraordinary members. And our members are uniquely successful, on average about 1 in 10,000 by success. What that means is if you have 1,300 members worth close to 150 billion, our members have net worths between 20 million and $1 billion. And on average, in the middle, they're at about 110 million. And that makes them about 1 in 10,000. And the best way to understand that is if you're in the major league football, baseball, or basketball, you're about 1 in 17,000 by accomplishment. And if you take the all-stars out of any one of those leagues, so you have the majors minus the all-stars, think of the all-stars as the billionaires, and what's left is an extraordinary group of people. That's about 1 in 10,000.
Yeah, excellent. And what do you think in terms of members from a team perspective, right? One of the things that, we see in family offices, right, that everyone is basically creating a team of superstars and expertise around you, right, to build your wealth plan. So are members typically making their own investment decisions, with strategic members such as a CPA and everything? Or, to what extent are they outsourcing to, traditional wealth advisors?
So this is a core question because some wealth advisors were nervous about Tiger 21 for fear that somehow it would harm their business. What Tiger 21 is a confidential community where people can share best practices. And what that means is that when one person has a wealth advisor or a broker or somebody who's helping them make money in a productive way, they share that information with other members. And so for the best providers of services, whether it's legal services, wealth, investment, etc., for the best providers, Tiger is a way to crowdsource business because one member introduces another and another and another and another. But obviously, part of our discussion is for two people to say, hey, my advisor is giving me this advice and producing these results and charging me these fees. How are you doing? And none of these things are black and white because you might have earned less but taken less risk, in which case that's a good thing. But in the discussion, 12 really smart people can pretty much identify who the better performers are and who the worst performers are. And it's not a surprise that the worst performers get less and less business and the best performers get more and more business, although performance is very hard to quantify. And one of the greatest benefits you have is when you sit and talk to another member and say, how are you thinking about this issue or that issue? You start getting into the nuance that either excitingly or unfortunately is at the essence of investing.
Yeah. Michael, if you could give just one piece of advice to listeners about how they could accelerate their own wealth trajectory, what would it be?
I don't think there's any one piece, but there's three quick ones if I could share them with you. The first is that in the book I wrote, I mentioned that if you line 100 people up in any industry, not just finance, and line them up from least successful to most successful using any reasonable metric. So it doesn't just have to be profits or returns. It could be academic papers. It could be, there's lots of different ways, but use any reasonable basis. The half that are the most successful will overwhelmingly have had mentors in their life. And the half that are least successful will overwhelmingly have excuses for why they couldn't have mentors in their life. And peer-to-peer learning is a variation of that, because if you've just sold your business and you go into a group with a couple people who had sold their business 3 or 4 or 5 or 10 years ago, you're going to learn things you couldn't learn anywhere else. And but mentors in particular was the big learning for me. I've been as lucky as can be to have had about a half a dozen mentors across my 50-year arc from when I was a teenager of people who've helped me along the way. So I would say mentors is almost certainly the number one. The second is many of your members may be aware of something called the marshmallow test. It was a test with young kids, 2 and 3-year-old, I think 3-year-olds, where they put kids around a table and one marshmallow in front of each of them and said, I'm going to be back in a little while. If the marshmallow is still there, I'm going to give you a second marshmallow and you can have 2. And it wouldn't be a surprise that if you had 10 kids, not all of them can wait. Most of them might want to eat the marshmallow first because they're not sure when you're coming back and how long they're going to wait, and they're not even sure if they believe you. And there's always a few kids who are disciplined enough or smart enough or wise enough to wait, and then they get the 2 marshmallows. And it turns out, as silly as this little experiment seems, they tracked these kids for the next 30 and 40 years. This has been going on for decades. And it turns out that the few kids who could wait for that second marshmallow learned about delayed gratification. And in almost every important endeavor, delaying gratification, making the investment up front, but not reaping the reward for some time, those who know how to delay gratification through discipline or personality are predisposed to be far more successful, because people who want to take the rewards out of an early career don't have the resources to reinvest them and use the power of compounding to build great success. I think I'll
Wow.
stop at those two.
Yeah, really, really fantastic. So many things kind of come to mind personally off the top of my head from that. So really appreciate you sharing those with the audience, Michael. Really appreciate you coming on the show today, giving so much value to the audience. If people would like to, learn more about what you're up to at Tiger, some of your other companies, some of your philanthropies, or would like to get involved, what's really the best place to reach out?
Through the Tiger website, www.tiger21.com. That seems to be sort of the best portal to just get a snapshot and dig in. And I'm available on LinkedIn as well.
Super. And then how about one more last question, Michael, a trivia question. How did you came up with the name Tiger 21?
It stands for the investment group for enhanced results in the 21st century. And, there's for people in finance, they'll know that there was an amazing investor named Julian Robertson, who was the founder of the Tiger group of companies, Tiger Management and so forth. He went out of business in 1998 as one of the greatest legendary investors just when we were starting. So I wasn't taking my name from him because he had basically said he was through and he didn't understand the way the markets were working. But he's been the greatest father of what are called Tiger Cubs. There's literally dozens of his proteges who have gone on to build multi-billion-dollar funds, some of them the most successful. But we had to accommodate one another. And so we can't sell securities the way Tiger can, and they can't run high net worth learning groups. We have what's called a mutual recognition agreement that has worked fine for the last 10 years, and I expect it'll continue to work fine.
Wow, that's great. Michael, thanks again for coming on the show. It's really been an honor to, learn from you and, the community that you've created. Super impressive what you've done, how you've been able to give back. Is really impressive as well, and an inspiration to others. So I encourage listeners to definitely, reach out, follow what Michael's doing, what Tiger 21 is doing. Definitely the elite group in the space, and very well aligned with our thinking here as well. So thanks again, and talk to you next show.
Thanks so much.